macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen.
Is the secular bear market over? I think it could be, and I'm looking for evidence to prove it. So I want to begin this discussion now, and I think it'll be one of the most important discussions we'll have in 2014. We know what the Fed's doing, no more questions there. We know the economy is improving, but we need to talk about valuation and if there's another big bear market around the corner, if there needs to be. All right, got a new setup here. I've got a laptop in front of me, so I don't have to turn around and look at the screen. So when I look down, I'm going to my charts here. All right. So I said I wanted to begin this discussion about a couple weeks ago, and I'm finally getting around to it. Since then, I found an article by a gentleman who believes the secular bear market is over, Chris Poplava, on Doug Short's site. Doug Short is a quant advisor perspectives, his site, where he's got just a lot of great articles, a lot of inflow of articles by fund managers, analysts, etc., and great free resource there. All right, so let's define what this whole idea of secular bull and bear markets, and I'm going to use a chart from Doug on his site, one he did recently when he looked at the question in early December. So what do you have here? We've got these long stretches of bull markets in blue, then your secular bear markets in red. He's highlighted some, the peaks and troughs here and the gains from the troughs, the drops from the peaks. When you talk about this, you're also, when you talk about these secular means long term. So it goes beyond any short-term business cycle that you might have, say of 3 to 5 years. Secular is what is the long big trend and what's it being driven by. Now, it should have a couple of elements to it, right? Time, and they tend to sort of mirror each other. There was a 17-year bull run from 82 to 99, and everybody said, well, now we're due for a 17-year secular bear, and well, that would take us into 2017, right? A few people, I should say, myself included, are arguing, no, we don't have to, take this market back down to the lows. Okay, back to the chart here. So time and valuation is the other question, obviously. We're not going to get into the valuation discussion today because that's a long and complicated one. We'll do that next time, with the PE10 and that whole sort of thing. When I just look at this chart, two things stand out here. You have to notice that, hey, these declines, the 66 to 82 bear market, down 63%. And then what did we do from 2000 down to March 09? Another 60%. Hey, that looks like it was sufficiently, a secular bear market. Maybe not the same time duration. But the other thing you want to notice here is what has Doug done with this chart. It is inflation adjusted. So what you see here is that the 2007 peak did not take out the 2000 peak on an inflation-adjusted basis. And we just recently are now taking out, or coming close to taking out, the 2007 highs on an inflation-adjusted basis. So something to keep in mind there. All right, Doug's next chart here I'm going to show you, he runs a regression line, regression trend line. I don't know how useful this is for stock market data. I know it probably comes in pretty handy when you're looking at all kinds of other data, but price, is the regression line important? It might be for PEs, and that's how you have the discussion about the PE10. So let's look at Doug's regression line here, going through back to 1871. Now here's where the argument in favor of the secular bear market not being over comes through kind of clear, because how is the market running against that regression line? The 2009 lows only went 11% below the regression line. Not much of a secular bear market, some would say, and that we have to go back down. And now we're 77% above the regression line. So this, when you look at the chart this way, this is one that the bears would say, and the people who still believe in the secular bear market say, you see, yeah, we can keep rallying from here, but we're going to have to go back down. And maybe they think that means if you have the real bear market you need to and you crush PE ratios again, maybe that's below S&P 1000. I don't know. But we're having the discussion, and I expect to revisit this maybe at least once a quarter, probably more often than that. All right. Let me back up here a second. Remember to go to Doug Short's site, Advisor Perspectives, and read this article, because this guy's thesis, Chris Poplava, is that we've got a demographic tailwind into the year 2028. Sounds good to me. He's looking at it like, as adults mature into this, say, 35 to 55 age bracket, those are their peak earnings years. And even though the population is aging, we're still in the meat of this, where you're going to have adults in their peak earnings years driving the economy and the stock market. So that's part of his thesis. The other leg is rotation, the great rotation. He sees, the bond bull market ending and that money going into stocks. Those are his two arguments. Now let's go back to Doug Short. This is a chart that Doug put together from some Census Bureau data, and he says, not so fast, Chris, because what you're looking at here is, okay, you've got the green line, which are the peak earnings years, and he marks the ages 45 to 54. But what is trouncing that is people 65 and over, probably leaving the workforce and also spending less in their retirement. So, so Doug thinks that sort of outweighs the demographic argument. I think that we also have to consider the other mega trends here, such as emerging markets. You still have 2 billion people around the world who aspire to the lifestyles of the West. And I just saw a great stat from Artisan Partners that they believe middle class spending, it's not their data. They got it from the OECD, I believe. Middle class spending is going to grow by $35 trillion over the next, I think it was 10 to 15 years. That's an incredible amount. Actually, that might have been to 2030, so a bit more than that. But the idea there is that emerging economies and emerging middle classes are going to be the drivers of economic growth in this global economy. It's not all about the U.S. And you can't argue with billions of people and their governments trying to help them get ahead. Better homes, jobs, cars, houses, clothes, the whole thing. All right, and then there's the technology argument. We know that technology obviously increases productivity, and it changes society in many ways. So I think those mega trends will also be drivers. And so we've made these highs. Now the secular bear market camp says, hey, just because we've made new all-time highs, doesn't mean that that the secular bear is over. I'm trying to build the case that it could be, and love to hear your thoughts. Leave some comments down below the video here, and we'll revisit this question often. All right, before I go, let me show you my market timing map that we use for my ETF timing service. This was the map I gave our members early in December, and it's worked pretty good for us. We saw strong support at S&P 1760. That was sort of my line in the sand. And so if you put this together, this was the base case was a 70% chance we stay above 1760. I didn't see the breakout above S&P 1810. Necessarily. I didn't give it better than 50% chance in December, but I gave it a 40% chance. Because I knew that it would take some time and the market would need to digest, and that's exactly what it's done. So now after the FOMC decision yesterday and their token taper. We're back up to 1810, and I think it's just a matter of time before we make new highs. So at the time, I had I was basically at a 60% chance we'd stay below 1810 in December. But I'm a betting guy, and so this is what we do. We lay out scenarios and probabilities, and then we weight the odds with our positions. All right, and I should review the trades that are working for us. About a month ago, I talked about how to play gold, yen, and treasuries. We're short all three, and treasuries are kind of stalled here, right below 3%. But the short yen and short gold are working great for us. So if you're not a member of Market Timer, call us up and see if you want to get a free trial and take a look at what we're doing. All right, thanks for joining me again in the kitchen, and I'll see you next week.